Streaming. All right, welcome everyone. I'm John Slazas from Dharma Capital Trading, and you can follow me on X at Dharma Cap Trading. Check out our YouTube channel. If you see something there you like it, share it. We're on Substack. We're publishing a weekly outlook every Sunday evening. So you can go to our Substack, Dharma Capital Trading, and get access to that. And this video is going to give you more insight to how do you apply those analytics. And then you can post questions in my Bookmap Discord as well, regarding anything on Bookmap and our integrations with them. So we're all about fact-based trading, and fact-based trading involves making decisions based on objective data and analysis, reducing speculation and subjective biases. So we all have these, cognitive biases that can influence our decision-making process. And having a statistical baseline can give you a fact check for that. You got a benchmark. You have an opinion. How does that relate to the facts? When your opinion's in alignment with the facts, it's time to leverage things up. When it's not, it's time to back off. Trade smaller or don't trade. But having that baseline, it also helps to slow down. Instead of just always being in that reaction mode, and you're just firing away, and then all of a sudden, you put yourself in a situation you didn't want to be in. This is a great way to kind of slow that down, so you're making informed decisions, and that's going to improve your confidence too when you do that. What Dharma Capital does to help you do that, you check out our analytics. This helps to standardize your process, and we're going to get into that a little bit today. And we have integrations with different platforms and with Bookmap, so it can normalize your workflow, get the analytics right in where your eyeballs are at. And then we do more in-depth training in our virtual trade room to help you optimize your own tactics. Trading is personal, and your success lies within you and the work that you put into yourself. One thing you can do is register on our website and take our core strength assessment. Then that's complimentary, and that'll give you some good insight to what your strengths are, how who you are. When you read it, you'll say, yeah, that's me. But then how does that apply to your trading, and are certain traits that you need to be aware of because they could be detrimental to your trading, and other ones that you want to leverage up on. But that's available to anyone that registers with us. And our method is consistent, and that's what it's all about in trading. You want to be consistent to create a sustainable trade plan. And our method, it's always the same thing. We want to identify what the underlying context of the market is. What are the stake characteristics? What's the baseline? And everything that we go over here today, all the concepts that we are speaking about, these are all things that you can apply on your own. We're showing you the tools that we have and what we use. And we make it easier for you, but the concepts are the same. You need to define an objective tool set, and you need to define objectively be able to identify what is the context of the market. What is the state? Is it trending? Is it non-trending? Not a subjective bias or opinion from somebody else. You want something that's quantitative. And then you need to identify, where does that state change? Where's the condition going to be different? If you're, using the analogy of, you're in a house and you walk out the door, that things change. Where that door is. Structure alignment's the same thing. At this certain points, price points in the market, conditions are going to change. And, and how are they going to change is what's important. What's the expectation? And so this is all about fact-based trading is aligning yourself with the probabilities. What's more likely to occur? That's what it's all about. Always be in alignment with what's more likely to occur, or at least understand if you aren't, and then adjust your risk management because you know that you're playing with fire. And if you're over leveraged, deleverage. But understand the alignment, and then that's what it's all about, having that expectation. If this happens, then I do this. What's more likely to occur? And when you take that approach and you apply this method, you're not reacting to situations. You're anticipating situations. You're prepared for those situations. You're prepared for all the adjustments that you would ever do because it's a complete playbook. It's a complete map of what's happening. If we do this, then this happens. If it moves here, then I do this. And so I'm going to go over that, our playbook today. And you'll see posts from us on Twitter or on X, and you'll see our our Substack, weekly outlook. Anytime we're coming into here, this is just to give you better insight to what are these qualifiers. What does the green line mean, and how can that help you in your trading? And again, every concept we go over here. If we talk about sentiment bias, we talk about alignment, we talk about context, we talk about state. These are all facts you have to plug into your decision matrix. You need these facts. You need to know what these are. You need to understand this stuff. So you either need to you do the work yourself, or you need to work with a third party like Dharma Capital Trading to provide that for you. And most of the big firms, that's how they break themselves out anyways. If you're a big fund manager, the late great Scott Miner from Guggenheim Investments, he turned me on to Daniel Kahneman's Thinking Fast and Slow, and that's how he based his whole investment process. Is he separated all his groups. He had he had one group that defined the strategy. He had another group that only focused on risk management. He had another group that did all the quantitative backtesting work, and then he had the execution group, and each one was separate. So in the execution group, basically they were told buy this much and get it done, today or over the next 3 days. And the quantitative people would cut, and they would be on their own, just saying these are the results, and you'd have a portfolio manager that was kind of overlook things. But when the risk management team comes in and says we got to get out, then we got to get out, and it goes to the execution group. So you have this, checks and balances, and everyone's got that focus. But as an individual trader, you don't have that. You got to do it all on your own. So you need help, and we're here to help. We're here to provide that statistical baseline, that benchmark, that fact check to support you in your success. So, before we get into it, we are going to go over some live market stuff. So I want to go through this disclosure. Futures and forex and crypto trading contains substantial risk and is not for every investor. An investor could potentially lose all or more of that initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. We talked about, I touched base on, personality traits and understanding yourself, and, how you deal with, losses and risk capital is a big deal. And so, if trading with extended money is not the way to go, and it's going to really mess you up. So, really respect that, because you need to be clear-headed to succeed. So this is our playbook, and I'm going to get into it now in the different sections, and all basically all the components of facts that we provide. We're just, we're looking at anything, the granularity. Do we go into, understanding the different nuances, with back to the analogy, you're walking outside in the door. Well, is it windy out? Did it rain the night before? What are you planning on doing? are you going for a run? Are you going, down to the lake to have a picnic? What's the plan and what do you need? And, and what are the conditions? How are those conditions potentially going to change? What's more likely to occur and how do I need to prepare for it? And that's what the playbook basically does. It's identifying that context and to give you some structure. So it get to that if-then situation in trading. If it's this, then I do this. So we have this hard structure that we can lean on as a fact foundation. And the first thing that we do is we identify that market state. What is that underlying foundation of the market? Market state. Today we're going to get into Ether, and if we have time, we'll go into Bitcoin. But so this is Ether's in a bull trend, and so when you talk about state, and you could, what are some tools to define trend, or a state? You could, different moving averages. If you have, you look at what a couple different, a shorter term moving average, a longer term moving average, for instance, that's going to give you some sense of, hey, the market's above both of those moving averages, we're positive, where it's below both of those, it's negative. And if last price is somewhere in the middle between those, you could say it's kind of non-trending. It hasn't made a decision yet. So, that's a fact-based solution, but it is lagging, and that is an issue, versus, some of the quantitative work that we're doing. But this, as we define this market state, we're also identifying, hey, this is what your expectation should be. Positive trend. How do positive trends, perform? Make higher move highs, higher move lows. What's the structure of that trend? This is where you're looking at, where's the alignment come in? Where does that trend change? And looking at price action, you're going to look at the peaks and troughs. Quantitative work is a little different. It's anticipating where those higher lows should be, and it's not necessarily based on eyeballing price structure. This is market structure, and so understanding with the market structure is where is that alignment? When does this condition or this context change? And based on positive trends, when positive trends break structure, they have violent corrective moves. So we need to be prepared for that. And at the very least, we want to be prepared for the market. If the market is breaking structure, that's not, we remove our hope that the market's going to perform like a bull trend. Because this is where these alignment points come into play, where the market's either going to persist and start trending again from this alignment, or it's going to break structure and it's going to shift into some type of corrective sideways or potentially, hard corrective break. And so that's always what we're identifying. We identify that base context, and then we're identifying the structure that defines it. And the main structure that we use, and the red lines are, you could think of them as resistance. The blue lines are major support. We call this our critical range, which is really the foundation of market structure. You've got a midpoint within that critical range that the market will rotate around, but this is basically the area of indecision. And you could see how this critical range structure is defining this bull trend state, defining the upper peak where which defines where the market will break out for a new impulse higher to higher move highs, or it's defining the lower trough of where the higher low, higher high campaign is broken. As we'll see as we get into more detail, you can see there's a lot of numbers here. Basically, you could look at this as a ladder. The market likes, as the market trends higher with price structure, same thing with market structure. It just climbs the ladder, climbs the steps. But the difference is, the qualifiers and what it means, and understanding that, hey, if we're outside this critical range, the market's making a decision and it could have a big move. And, if the market's trading above the midpoint, it's leaning to the upside. If it's trading below the midpoint, it's leaning to the downside. It's going to stair step down, one step to the next. And then we also, we're identifying validation points. Well, if we do break out, market's got to validate above this price point. We call it critical range positive extreme. Below the downside breakout, we've got a validation point on the downside. So as a trader, you've got some insight to, this thing's validated. It's breaking out. I'm anticipating it. I'm in it, but I'm not comfortable until it's validated. And then these are interior validation points. So as you're moving through the critical range to the next level. So again, you just stair stepping is the way the market goes, and we'll see that in real time as we flip to a market. But this is just to really just give you a quick overview of the analytics, so that when you see these images from us, you have some sense of what they are, so you can take advantage of those opportunities and to anticipate them, and to proactively manage your risk. The other so we've got the two points from the critical range: upside pivot, downside pivot, and we have what we call our sentiment bias. And this is an over-under number. And so this is the main point every trade period, where all the liquidity is at. This is where all the big money is focused on for that time frame. Where is sentiment going to shift? And the thing about the sentiment bias is it moves around based on the state, and it can be in different places. But what happens is it's going to change the context. So if market's in a positive trend and sentiment's below the market, or in this position at the downside pivot, it's just telling us, hey, it's in alignment with the structure. And in the playbook, we're going to identify that. We're going to say, hey, yeah, we're in a bull trend, and sentiment's here, and so that's what that means. And so it's just giving more granularity to the context of the market. Because sentiment and a bull trend could be in 9 different places. And so if you're and currently we're in this situation. But if we were in this situation where we had sentiment above the market at the upside pivot, that's we've got sentiment is above the market, so it's negative sentiment in a positive trend. So that's so that just gives you more insight as a trader. We're in a bull trend that might correct today. I need to be prepared for potentially a violent corrective move or a sideways digestion. If the market's challenging the upper structure of sentiment, and you've got to cut. You could sell some options with the expectation this thing's not going to follow through. You've got market is going. You're selling calls here as the market's coming into this area. You've got a market. Two things that can happen in your favor. The market's going to fall back into a digest and go sideways, or it's going to pull back because the expectation is for a corrective trade. And the same way is if you're in if sentiment's way below the market. That's telling us that, the energy is way below the market. So if we're getting involved in a market here, we're getting buy signals, there's not a lot of energy. So you need to understand that I don't want to press it up here. And if I do get a big positive push, it's more likely to have a pullback, more of that stop and go action. So just again, it comes down to just really having good awareness of, where sentiment, how is that going to affect the state? And it's going to give us insight to that. Are we in this part of the bull trend, this corrective part? Are we in an acceleration part? Where are we? Where's the energy? So I can, align my size management for the opportunities. And along with the market structure of defining those alignment points, we also need to and again, this is all things, everything that we're going over here. Obviously it's being applied to our technology and what we're offering you and what we have to work with you with, and that's what it's all about. We're interested in working with traders and developing them. You need to answer all these questions basically. So these are all things that you need to understand. You need to define and ideally have some objective resource to define it. And so one thing that our structure analytics do is we have reward metrics and risk metrics. And our reward metrics, we use an acronym, average price map distance, APMD. And this is identifying the segment moves the market's trading in. So this is telling us what the market's paying us out. And I'll look at different markets and just search out, the APMDs of, who's paying out the biggest, who's having the biggest movement. Ether right now is basically paying out $30 a move. So if you get into a trade in Ether, that's what the market wants to give you. It wants to give you $30. So you want to take it. You want to take what the market gives you. And so you typically, and we'll get into this in more detail as we look at the live market, just to show you how this stuff works and show you these segment moves. But, at the very least, you're taking a half APMD out. So, it's $14.91. So basically $15. But you have to take that money because that's what the market's paying you. And whenever you put capital at risk, it's exactly that. So you're at risk for a certain amount. No matter what, you just enter and you're at risk, and you're already behind the eight ball because you already paid whatever that spread is to get into that trade. And so so what this gives you, it gives you insight that before you even do anything, you have an expectation of what the market's going to pay you. And so again, market's going to trade in half, full, and times two segment moves typically. Absolutely, you can have event situations where it's going to trade 3 or 4 segments, but this is typically if you're going to standardize your approach, that's what it is. And you standardize it to your state. So if you're in a positive trade and you're in a long position, you're going to go for 2 segment moves, let's say. And if you're in a negative, if you're in a sideways state, so if you got a positive signal, you go for 2 APMDs, and if you're getting a sell signal in a bull trend, you're going to go for 1. As simple as that. Just it gives you some expectations. And then we define the risk that you need to take. So we've got a few risk metrics. The variance is basically more of an entry level metric for the zone, the boundary around a price map level that really is like at the level. That's the choice area. If you're always trying to put your entries right at a price point, you're going to miss a lot of good opportunities, but you're going to participate in all the losers. So you need it. So this identifies that kind of that sweet spot. And then the alert distance is going to show us, which is around $4 right now, $4.17. And Ether is kind of the area of signal acceptance around a price point. So this helps to identify, okay, well, the market's within $4 of that area, and I'm getting a trigger off one of my systems, or I'm getting just what I'm seeing something in the order book. As long as I'm in that alert distance, I'm all good. And you can use those to so basically if I'm using the alert distance as a risk parameter, I can risk 1 alert distance to make a half APMD, and I'm at a 3-to-1 risk reward ratio, so it's all good. And that's what we're looking to do. Just always put ourselves in situations where we can lose more times than we win and come out ahead. And psychologically, you see other systems that today we've got 99% of the time we win, but they're making a tick, and then when they lose, they're losing 1,000 ticks, and so they just kind of blow themselves out. So psychologically, it's easy to handle taking lots of winners every day, for a month, and then blowing out the last day of the month and giving it all back and starting from scratch. So you need to flip that. You need to risk a little bit, risk a little bit, risk a little bit, make a lot. And that's what these risk reward metrics help you do. The goal here is to create a structured approach by standardizing your trading methods to the structure that defines the market state alignment. Focusing on alignment and standardizing your tactics to it. So we want to conform our tactics to a standard. We want to align ourselves with what's more likely to occur. So if we're in a specific state and we identify the structure of that state, then these are the strategy themes we want to look for. And again, this is things that you need to define for yourself as you identify context and the structure that defines it. What's the obvious and logical opportunities for that state and structure? Well, in this situation, with the sentiment at the downside pivot, buying a break off that level is the best opportunity, because this is risk. Sentiment's going to change here. It's no longer going to be a bull trend. That's not going to be true if we start trading here. We're going to be in some other state. But as long as we're holding that structure, it's all good. And if we're able to enter near that area, it's the least amount of risk for the biggest amount of reward. And the next best thing is to, get this trade on and then leverage it up when the market goes through the midpoint, or what we call our directional. And so, it's obvious, but it's something that you need to take a fact check and see, hey, yeah, because of this state, this structure, this is what we do. And we break it down into what we call optimal themes. So optimal themes are when the market's performing to the expectation of the state. Those are the best. These aren't the only opportunities. It's more of a theme. So, you're looking for, if the market's in an optimal theme, it just means that it's performing to the expectation of the state, and we want to jump on a positive train. And then if the market breaks structure, we have some, what are some potential strategies that are going to benefit from a shift in or a transition in state? If the market breaks out to the upside, can't hold it, and gives us a false breakout, it could be a reversal signal. That's the initial tell of potentially a top in a market, right? You get that capitulation at the top, reverses. The big thing about having the price map structure is that you're able to anticipate that, and where that is likely to occur. And so you can be ready for it, and you can be ready for it in the microstructure in the order book to take advantage of it. And then the optimal thing here, or the biggest hedge opportunity, is we get this reversal signal and the market breaks structure here and it just goes. And so if the market breaks structure below sentiment, it shifts the market out of a bull trend and into some type of corrective trade. And so those are our hedge themes. So we have, is the market, as a trader, you're always identifying for the market, is it performing to the context of the state? If the market is context of the state is bull trend, does it look like a bull trend? Are we making higher move highs, higher move lows? Is the market gravitating higher? If it's not, then that's a problem. Then that should be a light that should go off and say the market's not performing to the expectation of the state. Is it holding structure? It is. So maybe it's just digesting. Is it breaking structure? That's a different story. And if you're long, you need to understand, if the market's breaking structure, that you need to do something. You don't, and hope isn't the answer. So you need to, this is where the fact checks come into play. And also on signal acceptance. So, if the market's breaking structure and you're getting a buy signal and you're anchored on the market being in a bull trend, but the structure alignment's broken, that's where the fact check comes in as well, because it's going to at least, ideally, it's going to at least dial you back on how much size you put on in that trade. Or, tell you, hey, this signal's not in alignment. I have to risk a lot less. So that's what it's all about. Identifying context. That's, when you're setting yourself up to trade every day, you're coming in to define what the context is for the day. Are we in trend mode or non-trend mode? What type of trend are we in? Is it accelerating? Is it digesting? Are we, what's that underlying foundation, and what's my expectation on that behavior, and is the market behaving like that? And then understanding the structure. Where's the alignment point? So that thing's going to change. And because we're in that alignment, in that state, what are the optimal and hedge strategy themes? And so now you get to work. Now you got your alignment. So now your expectation, you're coming into the trade day, your expectation is, okay, I got positive structure. I'm expecting short pullbacks that aren't going to follow through. And what tactics do I want to do? Well, I'm, trend following tactics, and I'm looking to accept buy signals. And these might not be the only things you do. You might see, some choice thing that comes along and you want to just take advantage of it. The market gets out of alignment and you're going to scalp around something, but you don't lose sight of the fact that I'm a buyer. I'm a buyer above this structure point, and that's my story. I'm sticking to it. I avoid those, even if they're little gimmies. A lot of times I'll just avoid them anyways, just because I don't want to get myself stuck, fading, get on the wrong side of what's more likely to occur. Yeah, I'd rather just wait and just, and wait to and trade bigger. So, now you can anticipate. I'm waiting for what's the market going to give me today, and I know where it's going to make these decisions, and I'm anticipating opportunities. And I know that, I'm not, if you use oscillators, I just use this as an example. Yeah, I'm going to turn off all my tactic toolkits that are for non-trend. It's not, because that's not where we're at. And I'm going to turn off my, my fade setup at the upside pivot, and I'm going to focus on my, my MACD. I'm going to focus on trend following. I'm going to focus on my momentum signals in the order book, and I'm going to look for those signals in the order book. And when they start to occur, I'm going to jump on them. And I'm also going to see that if they're not occurring, that's an issue, and then this market might be in transition. And so again, that context is going to give you that insight to trade more intuitively, which is what it's all about, because that's when you really succeed, is when you are trading intuitively. And so, now we're getting into the kind of the microstructure where we're going next, is just to optimize. We're going to make this our trading as perfect as possible. We're defining that state. We've defined the structure of the state. We know what the optimal themes are, for the optimal themes and the hedge themes. And now we're going to, now we need to get into the order book. So we have our strategy and tactic foundation. We have our risk reward parameters. And now we're in the moment in the order book, reading tape to identifying, is this expectation occurring? Where are we at? And is the order book showing us that? So we have our macro strategy foundation, and we're reading tape in the microdynamics of reading the tape. And before we go live, I want to just show a couple examples of these major themes. Again, and these are the backdrops. So what your trading style is, if you're a shorter term, longer term swing, position, these are all kind of the same things. In the, if you're just on the microstructure, it's what's happening in the environment. But when you work with the playbook, we're going to identify a couple different themes of fade, tactical themes of fade, breakout, and reversal. So we're either going to be fading momentum into a figure. We're going to be which is basically when you fade something, the market needs to be trading above it first, and then you fade into it. So that's an important feature of a fade, is that the market was first in front of that figure, and typically by the metric boundary. So when we, this is what we display on our integrations, is these metric boundaries. And so, and here, as I talked about before, is the variance is the optimal area. So not trading at the figure, but optimally at the variance. But really anywhere in this area is signal acceptance for a fade. But the other thing about a fade, if you're fading momentum, what's important about fading momentum? The market should stabilize in front of it anyways, because you're expecting higher lows. So you're not expecting it to go to the figure, and it definitely shouldn't go below the figure. And if it does on a fade, there's an issue with that fade, because that breaks the definition. And again, that's everything that, whatever, if you're identifying a price point and the idea is that you want to fade momentum into it, well, it should hold. And if it takes it out, that's a problem, even if it takes it out by a little bit. Because if it's really a good one, which is the only ones you want to be, you're always looking for the market to be perfect, because it is perfect. And when it's not performing perfectly, it's telling you it's doing something else. And so the other strategy is a breakout, and the same thing on a breakout is, to be a real true breakout, the market needs to start below it. So it has actually two alerts. So if the fade has one alert, it needs to be in front of it. A breakout has two. It's got to be, in a positive breakout, it's got to start below and break out above to give you that energy. And then typically the best breakouts, they're not going to pull back at all. They're just going to go. And so, if you want to get into a trade, get in. And then work on your size. But get involved. And then, so if you're getting involved here, there's no reason you can't put some extra orders down here. So if you do get that pullback, and also where has the market been? What's it done? What's happening in the order book? There's a lot of decisions that go into play here. But basically, if the market's really good, it's just going to go. It's not going to look back. And if it doesn't, there's a tell that this might not be working. And then the other strategy is a reversal. And so that has 3 alerts where it needs to start above, give you a downside breakout that's a head fake, and then price qualify back above the metric boundary to say, hey, that we've reversed. So this is classic V capitulation signal. And again, this is kind of like a breakout where, yeah, it should just go if it's really true. And again, you're anticipating the signal acceptance within this zone. And on these trades, the market really shouldn't push through that figure. So just a couple quick examples before we go to live market, just to kind of see how this all plays out, where you've got a market, and this is kind of a classic reversal setup where market's starting below, you're getting this breakout above the upside pivot, so it's moving outside the critical range. This is all good. You've got this beautiful trend. Market's making higher move highs, higher move lows, and then here it breaks structure. It's breaking this price structure low here, breaks the price structure low here. Now we break market structure, and this triggers a reversal, and this would be a 1 APMD move as a target. A lot of times you'll have situations that a hedge theme will roll into a optimal theme or vice versa, and this is an image showing a breakout strategy that's more aggressive entry coming into a fade strategy that kind of just fades into that whole area. But the big thing about everything that we're going over, this is a unified approach. You could apply this to any market, any asset class. It's all the same thing. And as we talk about optimization and trade tactics, that's optimizing any of your trade tactics can be done, or any of these themes, with the dynamics of the order book. Looking for liquidity shifts. Where's the resting paper? Is there an imbalance? What's the intensity of trade? Who are the aggressors in the order book, and where are those happening within the structure? Are there any large lot orders that are supporting a lot of liquidity supporting structure? That gives you insight. This helps to identify stop placement as well. And so we're gonna get into that now. But basically, as we get into it, the underlying theme for optimization is we're observing price action within market structure in the context of the market state and underlying strategy themes to gain a competitive edge and the ability to anticipate opportunity within the market metric thresholds during a dynamic order book events. So how is the price action working within structure? So I'm going to take the structure off. So the playbook, we've got historical here, we've got different asset classes, and we're looking at Ether. The color grid, helps to identify quickly, markets that are in similar states and structures. So just, going out, what's the context of this state? It's positive trend. So what I did is, okay, well, what are some trending indicators? Well, here's a MACD and here's some moving averages. The other thing I like to do, for fact-based trading is time frame structure. So before I even get into it, how's the market performing basis yesterday's price action? And so this is giving me some insight to the previous day's high and low and midpoint. All right, so now we come in and we're identifying the structure, so we know that we're in a positive trend. Structurally, sentiment's below the market. So we know that this is, where the real energy is. So as we come in the session here, the start of the session, we know that 1859.92 downside pivot is where the big liquidity is for today. We put on the critical range. This gives us insight to where we're going to find some resistance. Where's that upper peak? And we have our rotational number that's in the middle of the critical range. It's not necessarily symmetrical. It's going to give us insight to, okay, well, below this price, we're looking to gravitate down to the downside pivot, potentially set up a buy opportunity, or we're trading above the directional, looking for a rotation up to the upside pivot. I showed you those validation points before, and we know, context is bull trend. We're buying breaks. We can use, let me blow this up a little bit. Well, we don't need this right now. We know our strategy themes are buying dips above the R level and pressing it above the directional. And our hedge is if we go below the R level and if we get a reversal up here. So we can take a look at the order book and see how this stuff all played out. So the first 4 hours in crypto is what I call the opening phase. So the market's making a decision, and it typically likes to, kind of press it to the upside. How far the bid's going to take it, press it to the downside. How far, the offer's going to take it before the market kind of makes a decision. So the first 4 hours, which, here UTC time 4 a.m., kind of gave us this opening range. But I threw some moving averages on here, and basically we're looking for the market to be trending positive, and we know that if we're below the directional, we're not doing that. Let me shrink this up here. Oh, I don't have all that data. We'll come back here. So all this stuff's not that interesting, right? Because we're not. We're waiting for the market to get on a bull trend. And right now we know it's corrective, but we also know sentiment's below the market here. So any sell signals, this is the low point, and this is actually our buy area. So do you really want to play that game of catching this corrective trade? Maybe you do. For me, I'm more interested in just finding big opportunities and trading big on big opportunities. Basically, they have the biggest bang for the buck. And so and when things are most likely to occur, and in a bull trend state, when the markets are above their moving averages and the MACD is shifted, and and we're holding positive price structure and market structure, that's all good. Let's go. And so waiting for those opportunities. So here the market it's getting corrective. It stabilizes off this CR minus, which is a validation point, and this is a tell. This is a tell. This happens a lot where the market will create a rotational trade within the critical range, and it does here. And then we start to, now we're starting, is this market going to rotate up to here? That is, definitely a digestive strategy on the price map, is that the market stabilizes. It's something that we teach and train on in our trade room. The market stabilizes here with sentiment, which is buy break bias here. It can produce a rotational trade up to the CR plus, and even if that's going to be rotational and end the session as a sideways trade, this current opportunity that's happening right now, this is a structure high point, and for a rotational sideways trade, and the market, taking the market out by a tick here. And now we got this little tick here. This is actually pretty interesting situation with what we got going on in the order book. And we do see some liquidity building up here at the upper metric boundary. So basically, as long as the market's below 1906, we still haven't validated a breakout of this directional. What do we have going on though? We are in a bull trend, and this is just kind of a holding pattern for a higher move. Because as long as the market is holding price structure, holding market structure, and so then if we start to see some liquidity shifts here that start to support the market above the, let's say 1900 in Ether, that's going to be the tell that the market's ready to have a new advance and have advance targeting at least this 1919 upside pivot, if not the 1949 area. And so this is what we call our daily structure. And before we go into more of the order book, this is from our Substack. So what you're looking at here is weekly structure. So with the market in a positive trend, weekly sentiment's way below the market, and on a weekly basis, the directional, the market's opened up at the directional, shot up, and validated through here, telling us the market's positive, and then we had this, big choppy action, which somewhat, has to do somewhat with, there's no economic news coming out, and the market, hey, it's going to just wait for some news before it wants to make a decision. But the fact that it did trade above here was more positive, and you can see the price map distance, the average price map distance is a lot wider here because it's on a weekly structure. So this structure is not going to change for the whole week. And here's the daily downside pivot. So let's put the critical range on here, and let's put these upside targets. So the daily structure is going to roll tonight at 12 a.m. UTC time, or 7 o'clock Central Standard Time is where I am. And so what I like to do is look for alignment. So I know that currently we're trading here at 1900, which is basically the weekly validation number. And I also like this, when you see the higher time frames align with the shorter time frames, it's also interesting because here you've got the higher time frame alignment with the UP and the UT1. And so when you have the weekly structure in alignment with the daily structure, it makes it much more powerful. End of the day, bottom line, you want to get clarity, right? So if you don't have clarity, don't trade. When you get clarity, trade. And so this understanding the context is just to give you clarity. Whatever you're using to trade with, you don't want to trade unless you know and have good facts. And so what we know currently about Ether right now is it's challenging this validation point basis the daily, and it hasn't breached it. And we do know that the market did stabilize off the lower validation point. And so this is actually a structure. Let me pull the presentation back up here. This is right out of our tutorials where, the market will, if the market's going to be digestive and, kind of waiting for news and starting to coil up, and, so are we coiling up for a new advance? It's basically what the market's been doing for some time now after we had the big surge. this is, if the market starts to tighten its coil, what it likes to do, it'll like to rotate within these critical range interior boundaries. And that's what's happening now. And it likes to trade symmetrically as well. So as the market tests this level, and if it tests it, pretty much to the tick, a lot of times it'll kind of do the same thing. And then we'll, kind of end the session around the directional, kind of teeing up, waiting for the new structure. What's happening, here, as well as you have this, 1900 level is the weekly validation point, and basis the weekly, the market's giving us a tell that it wants to go higher by doing this. It's just a matter of when. And so, this thing could easily squeeze back down to these areas here and not mean a lot. Because as long as the market's above 1841, it's all good. And you can see how the metric boundary for the daily, our level is, basically at the very top of this signal acceptance area. Today, we didn't get that move there. The market actually stabilized off the previous week's high, but we're making a decision now. And this is so basically, as long as we're, if we can't base above 1900 in Ether, it's not happening today. It doesn't mean it can't happen as soon as the market opens up this evening. Or, if you do see the market start trading and basing above 1900, that's a signal to jump and to look for what's happening in the order book on liquidity events. Where are the aggressors happening? And when you see the market getting aggressive like this up here, that's going to be a good tell of an initiation for a new move. And if we can't base above 1900, what's more likely to occur is you're going to see a drop back down to this area. And then it's a bull trend. You're buying dips, and you're buying dips above the directional, and that's your story, and you're sticking to it, because if the market is really good, it's going to hold the VWAP, and it's going to stabilize along this area, and we would anticipate to see some liquidity build up within this metric boundary area, within here. And if we can't hold that, we're setting up this, and this would be something that would happen tomorrow. But it's not a time to be pressing it until the market validates. So if the market can't validate above this 1906 level, it's more likely sideways, and you could have one of these sharp pullback moves. So you have to be, so bottom line, your profit give back should be in place. You're at heightened, is the market performing to a bull trend? If it starts to break structure or it's not, it needs to really stabilize here, and see liquidity shifts, see the buy-in come in to stabilize this thing, to start building some, holding this positive momentum. And if we get a break in structure, it's a tell that it's over for today. And this market's just going to kind of digest, and that's what this kind of current setup has already told us. I'm going to just show you how fast you can go through this stuff with the right tools. So with Bitcoin, we're in a bull trend. Same thing. Structure is different. R levels at the directional. That means it's balanced. So there's no bias. It's real dynamic. When the R level's here, market's ready to do something. So basically, what's the optimal thing to do? Let's be long above the R level. And as long as it is, let's roll with it. And if the market can't stabilize above it, then we know that this isn't true, and we're in some kind of corrective move. And let's be careful for a potential reversal. So here we have Bitcoin. We had, this is what happens around the directional. It can be choppy. The market, this is where most of the activity is taking hold. The market told us early that, there's problem with this bull trend because it's not performing like a bull trend. So it kind of teed up this early failure here, teed up this choppy action. So this is right off the opening range, opening phase. And the market had this rotation. We had, basically this is telling us sideways. So even the current surge here, I got the wrong. So we can see the liquidity building up here, but this action here is telling us that this rally currently is more likely to stall. The market hasn't been really performing like a bull trend. It should have just taken off. It couldn't correct. It couldn't rally. You had a head fake here. This head fake here is providing this excitement right now. So we really want to clue into, what's happening here, and what's happening here in the order book is that we're getting some liquidity to build up at this metric boundary. And, based on what's going on in Ether as well, the market's not performing like a bull trend, basically. So we want to be careful getting sucked into this, this move. If we see the market able to base above 35,700, that's a different story. Because now, especially if we breach this metric boundary, because now we're validating, so we could look at this as, market's nonstop, right? So it's going to go through periods of sideways and of trending. And was this enough sideways for the market to start a new trend? And that's what we're looking at now. And events are good. This isn't that. It could have been a bigger event to really get more momentum. But when do new moves start? They do start after an event. So we have a little bit of an event here with this head fake to the downside. So basically the focal point for Bitcoin right now is 35,700 as to either the top of this inflection point or potentially the base for a new extension higher. And here's the weekly structure for Bitcoin. So we've had a market that, let me put on the previous week. We had a market that's, basically rotating around the directional basis, the weekly. We took out the CR Plus, basically telling us that it's positive. On the pullback, it couldn't get back below the directional, the R level. I'm sorry, it couldn't. It retested and the directional and stabilized. This is also the previous week's close and previous week's midpoint, so you had good alignment with time frame structure. So it's all good. We just, again, and here you have the alignment of 35,700. So getting and this is out of the Substack as well on our weekly forecast. This price point, the market needs a base above there. If it can't, we're still in this waiting pattern, but we're waiting for a rally. So are they going to suck people in here and then squeeze them near the end of the day, or is this real? And we'll see that. We'll see how the market, if we could see a liquidity shift here in the order book, and see this kind of action flip to below the market. So again, it's always a matter of, you know, monitoring price action within the context of the state and structure. That's what's going to give you the insight. That's what's going to give you the clarity. And then using those structure points, you know, to manage your risk, to identify your opportunities, put yourself in alignment with what's more likely to occur. So if you'd like to learn more, you know, visit our website. You can register with us, as I mentioned, and take our complimentary profile assessment. And so you register, you take it, and it generates some results. And then you can reach out to me if you'd like. We can go over them. You can also follow us on X and check out some of our other YouTube videos on Dharma Capital Trading YouTube channel. As I mentioned, you can register and sign up for our weekly outlook that's published on Sunday evenings. We're currently following Bitcoin, and also at our Discord channel. You can leave questions. So thank you for your time today, and I hope you found this interesting. If you do, and you're watching this on YouTube, like us, share it, and we look forward to seeing you next week in this channel. And good trading. Cheers.